Good evening. This is Ken Long from Tortoise Capital. It's September 1st, and want to take a quick look at our conceptual map for the ready, fire, aim trading technique, especially suited for chaotic markets. The general principle is that we can identify price action, which we would call the yellow zone, which is within yesterday's price action, between yesterday's high and yesterday's low, for example. This is an area where today the market is still uncertain because it hasn't voted one way or the other because it's still within yesterday's price action. So if we find ourselves in the yellow zone, we should have a particular strategy, which is to look for trades where we can clearly engineer a favorable reward to risk ratio using smaller position sizes, particularly if yesterday's price was narrow, as a narrow range day. Now, as the market heads towards green or red, we should be adding positions so that we can have a full position on if and when it breaks into the clear. If, however, yesterday's high and low price acts as resistance on the upside and support on the bottom side, then we would expect to see a reversal such as at this arrow, in which case we're going to have a full position on and at evidence of failure that we're either scratching the trade or cashing part of our 2-to-1 reward to risk. So we're only going to take trades inside the yellow zone if we can clearly see a 2-to-1 on a simple retest of the resistance level. And then if it breaks through, we've got a full position on and we're surprised into a multiple R gain. But if it fails there, then we're going to cash and see how much of that potential 2R win that we can resolve. Now, once price breaks into either the green zone or the red zone by taking out yesterday's high or low, then in the green zone we clearly can see that the market is acting favorable now, and we want to be in trades that are outperforming SPY, and we want to have a long bias. Conversely, when price fails through the yellow zone and takes out yesterday's low, we want to be looking for ways to be short. We want to be looking for things that are failing more than SPY so that we can short them, or we can be inverse. We can be long the inverse corresponding ETF. So an example would be some price action where we see something like a gap up opening. It comes up and tests yesterday's high, fails all the way through the yellow zone. We'd be looking for a 2-to-1 opportunity to be short here in the yellow zone because it started near resistance and then has all the way to the bottom of yellow to fail. We'd like to have a full short position on at the boundary between yellow and red, and then if it fails through there, that first breakthrough resistance is normally a very lucrative surge. If we're in the red zone, however, and we see a reversal, we're looking for it to stall near the boundary of the yellow and red, at which case we're going to be looking for 2-to-1 on the short side, or conversely with the corresponding inverse ETF on the long side. So to recap, what we're going to do is take a look at yesterday's price action to help us determine which side of the market to be on and to help us narrow down our targets. An example of that is from today's trade. We saw that yesterday was a very narrow range in SPY, and we identified a very narrow yellow zone indicated by this price action in here. The low of the day was at 101.73 yesterday, and that creates the boundary of the red zone. So failures through 101.73 are going to be indicators that we want to be short the market or long the inverse. And so what happened this morning was the market had a trivial gap down, went up in price to about 103.25, failed, had a minor pullback, failed again, failed all the way down to 101.73. Now, this is SPY. If we take a look at some corresponding ETFs, TWM is the inverse small caps, EEV is the inverse double inverse emerging markets. In each case, they're mirror images of SPY because the correlation is so strong. And when you see SPY failing with a lower high, we see TWM and EEV, for example, with higher lows. And so that's an indication perhaps it's time to get long. If, however, we just wait for the confirmation signal, we get a failure at 101.73 in SPY right here at about 11 o'clock Central Time, at which case it fails sharply and violently all the way for the rest of the day. This closes out here at about 2 p.m., but in the remaining hour or so of the market, it failed even further. And so if you just wait for that confirmation to the red zone, there was still plenty of room, for example, in TWM to get long at 32.63, and you're looking at 33.68 within an hour, and that's a 3% move with no overnight risk. EEV offers the same kind of entry at 16.43 and closes within an hour at 17.30, and so that's 90 cents on 16, or almost 5% move. And then the final one in SMN is the double inverse materials, offers an entry around 13.10, closes an hour later at 13.87, so that's 70 cents on 13, which is a little over 4%. So as you can see, the green, yellow, red zone analysis of the previous day's price action is very important, and especially the tighter the range, the more important that becomes, because the yellow zone is correspondingly small. So when yellow zone is small, we want to be prepared to take breakouts into the green or the red and use that as a guide for our market direction. And as you can see on a day like today, this was a snapshot this morning, their SMN was already up 4.5%, SKF, the double inverse financials, up almost 7%. SMN was a good target for us today because Alcoa and Cleveland Cliffs, which are both correlate with materials, were the biggest failures in our normal interest list. And so when we see that weakness, SMN was the natural target, and that was a pretty straightforward trade today. So that's the green, yellow, red concept for ready, fire, aim trading technique intraday. Thanks for your attention.